Welcome to the February 2026 edition of Student of the Market. At THG Retirement Solutions, we break down the noise. We provide a clear monthly snapshot of the market so that you can stay informed and focus on what matters most to you. The themes for this month are January's market momentum, the Mag 7 is trailing, emerging markets, the Fed pause, and lessons in diversification. Start of the year was positive. US stocks started 2026 with a positive plus 1.4% return in January. Historically, a positive January has been a good sign. Stocks finished the year higher 81% of the time following an up January month. On average, when January is positive, the rest of the year has returned positive 12.8% return. So goes January, so goes the year. The Mag 7 were off to a mixed start in January, combined for a 0.4% return versus the other 493 names in the S&P 500 were up 3.4%. February looks like an even greater dispersion, where only Apple is off to an improved February so far. More dispersion means the group is no longer moving in lockstep. Small caps are off to a hot start. January of 2026 marks the sixth best small cap outperformance versus large caps for a month since 1979. Small caps gained plus 5.5% in January versus a positive 1.4% for large caps. Historically, strong small cap Januaries have not consistently carried through to the rest of the year. Recent examples like 2021 and 2023 fizzled out. Still, momentum has been strong, and as we move into February, things still look good. This year, we have a midterm election cycle, which usually influences investor sentiment. The last two midterm years, 2018 and 22, were negative. We have never had three negative midterms in a row. The average US stock market return in a midterm election is 7.5%. Emerging markets have also surged and are outperforming the S&P. As you'll see here, over the last 12 months, emerging markets are up 39.6%. This is the largest EM outperformance over the US since 2010. Historically, emerging markets outperformance tends to cluster, often continuing for multiple periods. The weaker dollar is part of the reason for this, but we really like emerging markets right now. The Fed is currently on pause, but markets expect two cuts before the end of 2026. But the first one is not likely until July. Historically, when the Fed resumes cutting, markets have seen strong returns over the next year. Following a cut, large cap growth has gone up 25% the following year, international stocks up 23%, and US stocks up 21%. Pauses typically only last a few months, but economic growth and inflation look great, so we have a lot of room for the new Fed to cut. Winning more by losing less. At THG Retirement Solutions, this is our slide. The goal is to capture most of the upside and part of the downside so that we outperform over longer cycles. We go beyond the typical stock bond mix and add hedged equity exposure and non-correlating assets in our portfolios. This example that you see here shows a simple 100% upside, 100% downside capture, meaning when the market's up, 1-for-1 up, 1-for-1 down, and then also a 89% up and an 89% down. The diversified lower volatility path leads to a higher ending wealth despite lagging in some bull markets. Protecting capital during downturns has meaningful long-term benefits. Ask us if you'd like to learn more about how we do this. As a final takeaway, markets continue to move fast and headlines can be noisy. Staying diversified, understanding the big picture, and keeping a long-term mindset is how you stay ahead. As we continue to settle into 2026, it's always a good time to revisit your risk and make sure that you are invested appropriately. Please reach out to our team if you'd like to review where you are and how all of this information pertains to your portfolio specifically. Thank you, and we'll talk to you next month.